Welcome to 90 Seconds with Chris. Today we're going to talk about the 3 different ways a company can raise money for whatever reason they might need to. Let's go back to my bakery example. I decide I'm going to start a bakery, do my calculations, and realize I need $10,000 for startup costs. But I only have $2,000 in my savings to put down for this bakery. So I need to raise the difference of $8,000. To do this, I'm left with 3 options. First is by issuing all stock. In this situation, I create 10 shares, each at $1,000 per share. I keep 2 for myself with my $2,000 and I sell 8 to my investors. Here, I own 20% of the company and each of my other 8 investors own 10%. Second is by all bonds. I create 8 coupons, $1,000 face value, 10% interest per year, 10-year maturity date. In this scenario, I own 100% of this company. However, I owe each of my bondholders $2,000 at the end of the 10-year span. This calculates to a total of $16,000 for the bondholder. The third is a combination of stock and bonds. Let's say 50-50% for this situation. I raise $4,000 by issuing 4 shares at $1,000 per share. I raise the other $4,000 by issuing 4 bond notes, 10% interest rate, 10-year maturity dates. In this situation, I own 33.3% of this company. Each of my other 4 shareholders own 16.6% of this company. However, the company owes the 4 bondholders $2,000 each in 10 years. This calculates to a total of $8,000.